Yeah, so I mean, it is pretty interesting because the way you're kind of lining things up right now, like your own personal journey, I feel like a lot of people, in this 2020-ish to 2022, 23, 23 had kind of a similar run up, right? Because it seemed like after the COVID dip, when everything kind of went down, you could essentially throw your money at anything and it was going up and you kind of looked like a genius. And then, as everything kind of started to open up a little bit and the inflation or not inflation the stimulus checks and other things like that kind of started to run out, the stock market started to tank and it's been kind of going down lately. It has had a pretty good start to the year, but in hindsight, it is kind of hard to explain and kind of difficult for maybe a new investor to kind of understand how we got here and all these, the bumpy ride that we're going on. So, what are some of the, great fundamentals or I guess investing basics that kind of helped you get through that time to kind of, get where you're at today, where you feel comfortable in your investments? Because I think that's kind of like the biggest thing for new investors right now is just one, understanding what you're investing in, and two, kind of getting comfortable with the strategy and having the long term outlook. But feel free to take it away from there. I know I kind of rambled on a bit.
The number one thing that I did not understand when I first started investing was the relationship that exists between a business and its stock price. And the reason that that relationship is so confusing is that those two things can become completely detached from each other for extended periods of time, just completely detached from each other. You can have a business that's doing a mediocre job or even doing poorly, and yet its stock could be going up. You could also have a business that is absolutely thriving, growing like crazy, doing everything a business should be doing, and its stock price could be going down. And those two things can become detached from each other for years on end. So if you are investing for the very first time and you're putting money in the market, making that connection between the two is a really hard psychological jump to make. The media that we have today and the way that people talk about investing only makes that problem worse. And I think so many people that know absolutely nothing about investing know how to look up a stock price. If you said to anybody with an iPhone, what's the share of Apple right now, they might not have any clue what that means, but they know how to go to the stock app that's built into the phone and look up the price of Apple. And the tricky thing about investing is the thing that is always in our face, always talked about is price, 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 price. And it's natural for people to look at just the stock price and make conclusions about the business. Oh, the stock's going up. Must be a great investment. Oh, the stock's going down. Must be a terrible investment. And then when we layer on human psychology on top of that, it makes complete sense why markets behave the way that markets do behave. So if you were a new investor and you were interested in individual stock investing, the very first thing that I would encourage people do is to study the relationship that exists between a business and its stock price. Because once you understand, truly internalize and understand that relationship, it frees you up, truly frees you up to have a much longer term time horizon and ignore or do your best to ignore short term price movements.